Hey guys, welcome to the sixth episode of the series. Today we're going to be talking about lot sizes. And no, I am not referring to a parking lot. As I've mentioned before, to profit from the trade you have placed and in order to receive the best risk management possible, you should carefully choose your lot sizes based on your strategy. And that only can be done by you. Only you. So copying others is not an option for us retail traders. Every trader trades differently. It just doesn't sink in properly with our psychological trading. Because in the end, it's what happens after the trade has taken place that creates a profit and not before. So don't go out looking for some signals that you think will potentially provide you some profits. Anyways, without further ado, let's just get right into it. What is a lot size in Forex? As we've mentioned in the previous videos, that in order to calculate your profits, you'll need to consider two factors, the pip and the lot size. To get it out of the way for newcomers, the pip is essentially the difference in price or value between the initial entry of your position and the exit. It is usually to the smallest decimals, so if you were to enter at a long position in the US dollar and Japanese yen, which is at 106.873, and were to exit at, let's say, 0.880, then the difference in pip value would be 7 pips. But there is no way you can calculate your profits based on only pips, because you wouldn't know the value of each pip earned or lost. Now, the standard lot size is usually equal to 100,000 units of the base currency, if not modified. If you were not to touch or change the lot sizes, it would be 100,000 units, in other words. Now, with the amazing advancement of the digital era, brokerage firms have advanced to a point where they are able to offer traders the opportunity to invest in low amounts of capital. Doing that, they offer something called nano lot sizes, which can go as low as 100 units. It all depends on the broker you deal with. Some might only offer micro accounts as the least account type, others might go as far as nano sizes. Since a simple 10 lot size can wipe out a small account and eventually force a trader to quit their investing career, trading with low lot sizes could be the key. That's why Forex has a very low barrier to entry and is very considered by beginner traders who have low capital to invest in. But in the end, it's always down to the trader to create the perfect psychological effects and master the skill. So, as even if it has a low barrier to entry, it's very similar to other kinds of financial markets. It's just down to you. So, what does it mean for us? If it wasn't clear, it simply means that whatever lot size you decide to choose will determine the value of each pip gained or lost. Considering our previous example, if you were to gain 7 pips from the change in price level of the US dollar and Japanese yen, and have chosen to trade with a mini lot size of 10, which is equal to 10,000 units, for every one lot size is 1,000 units, then the profit would be $7. Now, this might be confusing. Let's just take a step back and break it down. Using a fairly simple method, instead of the financial equation, here's a table that's going to show you for each standard lot, mini lot, and micro lot how many sizes and the value it would be on the pip. So, for example, if you were going to go for the standard lot, which is the unmodified, if you haven't touched or changed the lot size that you initially wanted to put the position in, it's equal to 100,000 units. For for every pip increase or decrease, that would be a difference in value of a $10 per pip. So if you were gonna go up by 7 pips, it would have been $70. If you're gonna go down by 3 pips, you would have lost $30, and so on. Now you have mini and micro lots and nano lots. Since nano lots, not all brokers use nano lots, we're gonna talk about mini and micro. Mini has a size of 10,000 units. That is equivalent to $1 of value of your pip. So if you were gonna go up by 7 pips, you would have gained $7. If you're gonna go down by 3 pips, you would have lost $3. Micro has a size of 1,000 units, which is equal to $0.1 or 10 cents. So if you're gonna go up by 7 pips, you would have gained $0.7. If you're going to go down by 3 pips, you would have lost $0.3. So using that kind of table, let's just take an example to ease up the idea. Now, the financial chart is a 15-minute chart of the euro and US dollar. That is currently trading at 1.09079. Let's say we were to place a short position, which is selling, on that trade at the market price. Just for the sake of the example, we could also say that our analysis tells us that it would hit the support level of 1.08900 before a pullback. Now, this is just purely an example. Let's just say that our analysis was right. Now, in order to calculate our potential profit, we would have to have two variables, the pip difference and the lot size. In this case, our potential pip gain would have been 179, taking the calculation of 1.09079 minus 1.08900, which gives us 179. And for our lot size, as mentioned in the right panel of the image, is 1, which is equal to a micro size of 1,000 units, leaving us with a profit of $17.9. But what if we were to increase our lot size to 15? A lot size of 15 should be equal to 15,000 units, which is $1.5 in pip value. So for the previous example, our potential profits would have been $268.5. If we had an increase in 179 pips, we multiply that by $1.5, it would be equivalent to $268.5. Now, what if we were to increase our lot size to 35, which is equal to 35,000 units? In such a case, each pip value would be $3.5. So 179 multiplied by 3.5 is $626.5, and so on. But before we end this, let me go ahead and give you an insight on something. When you are going to enter in a position in the financial market, your entry isn't exactly at what is provided in the chart. Let's take the chart of euro and US dollar. If it is currently trading at 1.09079, your entry of a long position would be at the buy price level pointed in the sell by bar above. Your short position would be on the sell price level. Now, the difference between those two are called the spread. Don't worry about it for now, as we will be discussing this in detail later on. Just wanted to get it out of the way for now. In the end, calculations are usually done for you by the financial platform you are using. The reason behind understanding such a fundamental concept, like what is a lot size in Forex and how to use it, is to better determine the entry and exit point of your position and to enhance and minimize risk management by understanding how many hits you can handle if things were to go sideways. So this is it for lot sizes. I hope you guys enjoyed it. I'll see you guys in the next one.